Hello, and welcome to the Global Market Analysis for May 20th, 2016, as we review the week. My name is Jody Samuels, and it was another exciting week in the financial markets as investors absorbed information from the previous FOMC meeting to gauge when the next potential rate hike would take place. First, please read this disclaimer to yourselves, and thank you. To summarize, the S&P 500 tested lower levels at 2025, closing the week slightly higher than Monday's open at 2056. Oil rallied over $2 midweek to close at 48.56, despite trading as high as 49.29. The dollar, on the other hand, traded higher for most of the week, i.e. the EURUSD as a proxy traded lower, with gold down about $38 an ounce for the week, which is huge, and the 10-year Treasury yields finishing the week up 12 basis points to 1.84%. This week, the market was mainly focused on what went on behind the scenes in last month's FOMC meeting and ended up being largely surprised by the hawkish tone from the Fed. Despite a relatively slow first quarter, the committee noted that consumer strength resulting from a strong labor market and low energy prices will be a key driver for growth during the latter half of 2016. Although the Fed left rates unchanged at the last meeting, certain members sensed April to be suitable for a rate hike due to lower financial market volatility and improving economic conditions. However, the majority of the participants stated that waiting to raise the rates in June would be ideal if economic data warranted it. In terms of economic data, cost of living increased by the most since 2013, with CPI climbing 0.4% in April compared to 0.1% in March. The recent boost seen in energy prices and a lower U.S. dollar has allowed inflation to nudge closer to the Fed's 2% goal. The EURUSD initiated a massive late-day sell-off following the CPI report, indicating a possible rate hike in June. In addition, the housing market in the U.S. continues to remain solid after housing starts for the month of April increased by 73,000 units, beating expectations and hinting at stronger consumer demand. This chart shows how well the euro, oil, S&P, and gold have correlated since January 2016. Intermarket or cross-market analysis is key to understanding what is driving markets, and at any point in time, there are different drivers. Currently, the key drivers are U.S. economic activity and when the Fed will raise rates. This week, gold and the dollar followed their inverse relationship, with the dollar climbing and gold selling off. Also, the S&P 500 price action followed the movement of oil this week. This is a chart of the EURUSD for the last 5 trading days. It was a quiet week for data in Europe, and the EURUSD traded with new U.S. news. With the euro hitting a high price of 116.16 on May 3rd, this week was a continuation of the sell-off from that level, and the euro traded as high as 113.49 on Tuesday and as low as 111.80 on Thursday. The May 6th commentary said, next week we should continue to see the euro trade lower, provided we respect 114.80 and then 116.17. From an Elliott wave perspective, we are trading in a wave 3 down, targeting lower levels. This is our Elliott wave count on the EURUSD. It's the daily chart. And from an Elliott wave perspective, we are in a magenta wave 3. So we are in a wave 3 down, targeting lower levels. Crude oil prices saw a massive spike to start off the week and traded more than $2 a barrel higher before peaking at 49.29 on Friday. The initial rally came after Goldman Sachs, previously placing a target of $20 a barrel on oil, stated their new bullish price target of around $50 a barrel. The investment bank believes that robust demand and declining production has led to an earlier than predicted deficit. With that said, they cautioned that a pushback into $50 a barrel runs the risk of bringing on new production back into the market and hence into a surplus again. On Wednesday, however, the U.S. EIA showed crude stocks rising by 1.31 million barrels, which caused prices to bottom at 48.19 and traded higher up to 48.94 prior to the FOMC minutes. In addition, reports showed that Iran's oil exports were expected to increase by 60% in May year over year, adding further downward pressure to prices. Post-FOMC, however, the market acknowledged the Fed's hawkish tone for a rate hike in June, hence triggering a sharp rally in the US dollar. Thus, the dollar-denominated oil led to a sell-off in oil prices by about $2 a barrel before reversing losses on Thursday morning. Our Elliott Wave perspective suggests fading a move up to $50. Gold peaked on May 2nd at 1303.8 and for the last 3 weeks has been trading lower. Gold's stellar performance failed to continue as increasing concerns over the global economy, financial market volatility, and the Fed's ability for further tightening have all been a major factor in adding to the metal's gains. Gold has been rising in recent weeks as the market had only priced in a 4% chance of a rate hike in June, but this changed following the FOMC meeting minutes this week. The Fed funds rate is now giving a 32% probability of a June hike, causing a sell-off in gold as the US dollar strengthened. Looking at gold for the last 5 days, with the EURUSD plotted as an overlay, one can readily see the inverse relationship between gold and the dollar. And of course, EURUSD is perfectly correlated with gold. Finally, the S&P 500 followed oil all week long for the most part, as shown in this chart. After FOMC, the S&P 500 traded lower into Thursday to a low of 2025, only to give back all of the losses on Friday with the rally in oil. From an Elliott Wave perspective, the S&P 500 is trading in a choppy downtrend within the downtrend channel. Thank you very much for viewing the Global Market Analysis for May 20th, 2016. If you enjoyed this video, please like and subscribe.